On that note for this morning, for this afternoon. Well, with that, let's welcome in Amit Gupta, Senior Vice President and Fund Manager at ICICI Securities PMS. Amit, good to have you on. The market's having to deal with a lot, right? The news flow has been heavy from the election time till, then we had the budget, the tax changes, and now, of course, all the murmurs around Hindenburg. What do you make of things? I mean, at these levels, earnings season is also just winding down. Do you think this market has more juice to keep running? Or are we in for maybe a period of time correction, if not price correction?
So I think the later part seems to be more correct actually now. I think time correction is something which market actually, will be happy with it. The market participants will be happy actually with it because running away market is something, where a lot of participants remain at the lower level. I think now they may get an opportunity because the broader market, I think now is consolidating. You may get good opportunities. There may be some disappointments in the results because the prices moved up actually much in anticipation. Margins, I think going forward, if you look at the crude oil prices, they have not jumped up actually so much. It is still around $80-81 per barrel. So despite the uncertainty in the global geopolitical scenario market. So I think this is good from the margin perspective going ahead. And from the earnings perspective, I think from the index, you will not see much of a disappointment. Still the 12-16% of CAGR earnings growth will continue. And that is where I think the declines in the market, should be bought into. I think that's very clear. And post-budget, we had seen a decline towards 21,000. If you see financial year 25 EPS, of average EPS around 1140, the price to earning at 21,000 comes around 18 times, and the 5-year average used to be 18.5. That means we came closer to the 5-year average. And then we saw the FII money also coming in. It's very interesting. The 2021 onwards, we are seeing this pattern that FIIs generally who have not invested at elevated levels, they just invest when the market declines. So they are not leaving India. They are just waiting for attractive levels. And that's why at 21,000 again, in the month of June, you had positive figures from FIIs. So my sense is from the index perspective, it is more consolidation possible. You have to choose now your stocks where you see a good growth. Yes, some tactical shift towards some consumer names, ruler-specific names, possibly technology, possibly some textile stocks is possible, which have not participated much in the last 2 years.
So would you recommend this tactical shift towards consumption, rural, technology, textile names? Which one would you give preference to?
Yeah, I think why not? I mean, when we have made good money, in the core philosophy of manufacturing, infrastructure, energy transition, and also capex, why should not we, move 10-15% of weight into these sectors? And that is what we are doing actually. We have bought into some technology and some pharma names also, and we are very positive on it. For example, you take the case of Aurobindo Pharma. It has been in our portfolio for actually some time, and we have added positions actually there. It is a stock which is available at a much cheaper valuation in terms of its peers, and the growth visibility going forward is very high because we have seen that the penicillin G, which India used to import from China, almost 15,000 ton penicillin G is required, and this company is going to commission actually this one now. And then going forward, you will have biosimilar as an opportunity, right? And you have the cancer drug as an opportunity. So there are many things lined up actually for them. In fact, if you see the drug shortage in US, I think in December only we heard around 300 drug shortage. Now it has gone to 325. This number can increase to 340, 350 also in the coming months. And that can lead to some recovery in some of these pharma names because out of the shortage, 65% is in injectables, which is coming from these type of companies. So I think this can be a good growth. So different themes work at a different time. And I think this is what in the coming 5-6 months, when we will be more globally driven, because you have US president election, then you have interest rate decision to be taken. I think you will see these kind of sectors also possibly performing.
Okay, all right. I'm going to just hold that thought. I just want to address a couple of stocks. And, the Sarda Energy stock actually has moved to the high point of the day. We're waiting for a comment on the SKS power asset. That's the one that they were looking at. It was stuck in NCLT. For the time being, the street is reading some kind of positive development on that front. So we'll wait for confirmation on that. but the SKS asset was likely to bring in substantial amount of power into their business. So that's why that one's perked up. And another one in the last few minutes, our order win was Vascon. So that one as well did move up close to around 3.5% from the low point of the day. Amit, in the past, we have discussed the metals pack, and select stocks, I think Hindalco and Tata Steel, at some point of time, they were part of your portfolio. What's the view currently on metals?
So, see, in metals, broadly the view was that the downside seems to be limited because the metal prices actually were not going higher this time. They were subdued. The steel prices used to be 55,000 rupees per ton. Then this year it was 52,000 rupees per ton. So this was a different time than the previous scenario because it is more volume driven, more domestically oriented also. But then the hiccups always remain. For example, in China, we saw the GDP growth did not come up despite the interest rate cut situation. And that is where I think there was some dumping of metal actually in India. But I think more was protected because of the duty structure. But overall, I think the global growth is also something which will drive this sector going forward. We have to see this after the interest rate cut, possibly some reversal can happen. And also, I think the current prices looks very attractive to us. Yes, it's a matter of time when some kind of recovery along with the global can happen. I think the companies which are working on efficiency, for example, Jindal Steel and Power in this space, if you see they are getting some captive mines going forward, the raw material cost will get better, the EBITDA can increase. And obviously the EBITDA per ton is one of the best actually in the industry right now for this company. So it's in a recovery phase from that perspective, and I think it can pick up. So yes, you are right. We had to trim down some of the positions, but at a certain stage, we will add on the positions also whenever we see the global growth also is also, coming up going forward.
This move into pharma is just a tactical play for you short term because the numbers have been fairly strong in Q1 and even in the prior quarters. Or is pharma a long-term play for you? And have you upped your exposure?
Yeah, sure. So I think technology may be a tactical move more rather than pharma because there is a clear demand there is a clear shortage actually in the US market for the drugs. And the certain companies actually, they are just moving into the right segment. So that's why I think the pharma story has already been played out in the market, but there is still room for this story to play out further. Yes, from the tactical shift point of view, I think technology you can say is more aligned going forward with the interest rate cut decision, because if it happens, then obviously I think there may be some reversal in the technology space also, where results have not been too weak this time. What market was expecting, there is some volume growth also which has come up, but yes, not the same level of growth, and artificial intelligence still remains as one of the key dragger actually, because they are just coming out of this. They have to understand the business cases for which the softwares are made. So far, you were just catering to BFSI and you were aware of how the debit, credit and how the process flow happens. So you were ready with your software buildup, but now you have to work on your business requirement first, and then you have to work on your software. So it's a challenge. And the companies are coming out with. We saw that TCS came out with one Wisdom Next as the generative AI tool, actually integration of 3-4 generative AI things. I think those kind of things you will hear, and the success rate of that will drive the companies also, along with the interest rate cut, which is more a tactical move.
Okay, so that's as far as pharma is concerned. The market's still looking at the same level, basically 190 odd points on the Nifty. Not much has changed. So sort of talking about trends, Amit, I mean, going forward, we've got a lot of new IPOs, right? New paper hitting the market and very different kind of businesses. There's, of course, Ola, that's done very well. Today's two listings have done very well as well. Just give us a sense and a flavor. I mean, what kind of companies have found your interest in, what's captivating your attention? And something as specific as Ola, I mean, are you surprised with the moves, or do you think it's really a good play and there's still something left on the table for investors?
See, I think valuations definitely is something where you need to be a little careful. But overall, the trend towards the electric vehicles is actually gaining, is increasing continuously now. Particularly in the two-wheeler vehicles, where Ola Electric has presence, and we have seen its market share almost going to 35%. But the profit making has to come up, right? That's again very important feature which we used to see in the other new age technology stocks before that did not happen actually for a long period. So I think that is something where they have to work. In fact, the subsidy from the government also, which used to be there, it was reduced to some extent last year, and then we saw the decline in the sales also. So those kind of things you have to work upon. But yes, the trend is very clear. I think in the coming years, you will see 70-80% of two-wheelers being converted into electric vehicles, and that is where it's a good growth. I think the next trend, going forward in the listing space also is going to be from those companies which are already there, for example, in thermal space or hydropower, and their renewable energy entity is going to be listed. For example, NTPC. So NTPC, if you see going forward, the NTPC renewable is going to be listed. So NTPC already has 76 gigawatt of total capacity, and they have a target of 130 gigawatt by 2032, out of which 60 gigawatt of renewable they are talking about. The current capacity of 3.5 gigawatt in the renewable space, will be 16 gigawatt by financial year 27 ending. So they are working on both the fronts. And I think that is where this company will see a lot of inflows going forward. It has already been one of the rock solid stock in the market. But yes, I think this is the trend that we are looking at. Some of these renewable setups in these companies, even NHPC going forward, those are going to be listed.
Okay, Amit, thanks a lot for joining in and giving us your views on the markets as well as a lot of sectors and themes that we did discuss. Talking about